How options trading profit in any type of market conditions. Considering that you can always get or offer 100 shares at the existing market value, you might ask, why do I require to purchase an option to gain that right? The response is that the alternative repairs the cost of stock, and also this is the essential to an alternative's value. Stock costs might increase or fall, at times dramatically. Price motion of the supply is unforeseeable, which makes stock exchange investing fascinating, as well as additionally defines the threat to the marketplace itself. As a choice owner, the supply cost you can relate to sell or purchase 100 shares is frozen for as long as the alternative continues to be effectively. So despite how much rate activity happens, your cost is repaired need to you determine to offer or buy 100 shares of that supply. Ultimately, an option's value is going to be established by a contrast in between the set price and also the supply's present market price. An option is a contract that gives you with the right to implement a supply transaction, that is, to acquire or offer 100 shares of stock. Each option constantly refers to a 100-share device. This right includes a specific supply and also a particular set cost per share that continues to be taken care of up until a certain date in the future. When you have an open alternative position, you do not have any equity in the supply, and also neither do you have any kind of financial obligation position. You have only a legal right to acquire or to market 100 shares of the stock at the fixed price. A couple of important constraints come with alternatives. So each option applies to 100 shares, conforming to the frequently traded great deal, whether you are running as a purchaser or as a seller. There are two sorts of choices. First is the call, which gives its owner the right to acquire 100 shares of stock in a business. When you buy a call, it is as though the vendor is stating to you, I will certainly permit you to buy 100 shares of this company's stock, at a specified rate, at any moment between now and a defined date in the future. For that privilege, I expect you to pay me the existing call's rate, times the right to acquire or to sell supply at the set price is never indefinite. Actually, time is the most important aspect due to the fact that the alternative exists for a particular time only. When the due date has actually passed, the alternative ends up being useless and ceases to exist. As a result of this, the option's value is going to fall as the due date approaches, and also in a foreseeable manner. The second kind of option is the put. This is the opposite of a hire, the sense that it provides a selling right, as opposed to a purchasing right. The proprietor of a put contract deserves to sell 100 shares of supply. When you get a put, it is as though the seller were stating to you, I will certainly allow you to sell me 100 shares of a certain firm's stock, at a specified price per share, at any moment in between currently and a certain date in the future. For that opportunity, I expect you to pay me the existing put's cost. Times finally, each option relates to exactly 100 shares of stock, say goodbye to and no much less. Times each alternative also uses only to one certain supply and cannot be transferred. Stock transactions generally happen in blocks divisible by 100, called a round whole lot, which has actually become a common trading unit on the general public exchanges. In the marketplace, you have the right to purchase or sell a limitless number of shares, assuming that they are available for sale and that you want to pay the seller's price. Nevertheless, if you get fewer than 100 shares in a single transaction, you will be charged a higher trading cost. An odd-numbered collection of shares is called a weird lot. Adjustments in the supply's worth impact the worth of the option directly, since while the stock's market value adjustments, the choice's specified price per share continues to be the same. The modifications in worth are predictable, option evaluation is no mystery. Each alternative's value adjustments according to modifications in the cost of the stock. The worth of the call option will certainly follow fit and surge as well if the stock's value surges. As well as if the stock's market value falls, the call alternative will respond similarly. When a capitalist acquires the supply and also a call's market value climbs after the acquisition, the the capitalist revenues due to the fact that the call ends up being more valuable. The worth of an alternative in fact is quite foreseeable. It is influenced by the passage of time along with by the ever-changing worth of the stock. The features of calls as well as places can be made clear by remembering that either choice can be gotten or marketed. This means there are 4 possible permutations to alternative purchases. 1. Buy a call. Acquire the right to purchase 100 shares. 2. Sell a call. Sell to another person the right to buy 100 shares from you. 3. Buy a put. Acquire the right to market 100 shares. 4. Sell a put. Sell to somebody else the right to market 100 shares to you. Idea. Investors as well as capitalists need to formulate methods which will permit them to be profitable under any type of market condition when option trading. Regardless of just how the market varies, whether the stocks go up or down, skilled traders need to discover the right approach to maintain success and also develop income development. Millionaires are made with option trading each day. There are also others that are not as fortunate. So it is vital to recognize the nuances associated with market conditions, as well as how to optimize those problems in your favor. It is feasible to be successful when choice trading on the marketplace, whether the supplies are rising and fall up and down, or perhaps staying stationary. Many says that the traders and capitalists, with an understanding of the marketplace, as well as the different nuances related to it, are the ones that end up being successful, as well as make millions. A few of the approaches these successful investors and also financiers use include methods for when the marketplaces are up as well as others for when the market is down. Choice trading methods for when the markets are up include buy call alternative, market naked put alternative, and bull call spread. Buy call alternative is where you could purchase the same variety of equivalent stocks for a fraction of the rate utilizing call options, as well as revenue when the stock goes up. If the supply accidents after that, you will certainly lose the percentage you place towards purchasing the choice versus the whole quantity you would certainly have used to purchase the stock. Often used put alternative is utilized rather than purchasing call options implies you can sell short put alternatives by pocketing the entire quantity you made on selling the put choices if the stock goes up. When you acquire call alternatives at the money and market short out of the cash call options within the exact same month, bull call spread is. This strategy means you generate income when the supply increases or stays the same. When the markets decrease, the best approaches to make use of for alternative trading is buy put option, often used call option, or bear put spread. The buy put choice rather than shorting stocks and running the risk of a margin call, you purchase a put option. Acquiring a put choice is the same as buying call alternatives, however you profit when the supply drops, as opposed to up. Market naked call choice suggests rather than buying put options, you sell short call alternatives, and also make the whole amount from marketing the put alternatives if the supply drops. When you acquire placed alternatives at the cash and offer brief out of the money put alternatives within the very same month, bear put spread is. When the supply drops or remains the same, this approach provides earnings. Various other techniques that can be utilized for option trading whether the marketplace goes up or down consist of straddle and also strangle. When you purchase a call choice and also a put option at the very same strike factor for the exact same stock choice, straddle is. This allows you benefit whatever direction the marketplace is moving. Strangle is comparable yet gets of the cash call option and also placed alternative rather than at the money in order to reduce the expense of the placement. When the marketplace is consistent or moving sideways, after that a few of the best methods to utilize for choice trading include covered call, as well as short straddle. Covered call functions if you have a supply that is moving laterally, you can gather rental out of it by offering the call choice each month, and also earnings the entire quantity of the sale if the supply continues relocating laterally. Short straddle suggests you would certainly get call choices and also put choices similar to straddle, yet you would sell short to develop a choice placement which profits when the stock continues to relocate sideways. Sean Kemery manages assets trading and indexes. as a director, and also elderly investor at Deutsche Financial Institution AG in New York. Mr. Kemery likewise developed as well as manages the business's multi-billion-dollar business lines on major asset indexes. Alternative purchasers can benefit whether the market climbs or drops. The method is understanding ahead of time which instructions the marketplace will certainly take. One more method to keep the difference clear is to keep in mind these credentials. A call buyer really hopes and also thinks that the supply's worth will certainly increase. However, a put buyer is trying to find the price per share to drop. If the belief is right in either instance, after that a revenue may take place.